So, welcome back to another episode of Multifamily AP 360. And today's our guest is Kenzie from KRI Partners. Welcome back, Ken.
Thanks for having me. I'm great to be here
Yeah,
again.
yeah, thank you. A little bit about Ken. Kenneth is the founder and managing partner of KRI Partners and the KRI group of companies. He has more than 24 years of significant real estate, banking, private equity transaction, and principal investing experience. Throughout his career, he has been involved in transactions valued at more than 2 billion, much of which has included the acquisition, management, and financing of various multifamily real estate projects. Before forming KRI Partners, Kenneth was a tax manager with Deloitte and Touch LLP. So with that, Ken, you want to add anything new like from compared to last time?
We've been just out here doing our thing, fund after fund after fund, trying to make some good deals.
Awesome. Thank you very much. So it's been almost maybe 1.5, 2 years.
I
So
know.
what kind of challenges or opportunities you're seeing in the market, multifamily space or?
Yeah, this will probably come as a surprise to you, but the interest rates have been creating a challenge. Obviously, it's not a surprise. It's actually creating way more opportunities for us than it is. I mean, of course, I wish rates weren't higher, but I will tell you it gives us massive buying opportunities, because there's a lot of folks that weren't careful with their debt, didn't manage it properly, and now their interest expense is so high they can't make it work. So they're kind of in a distressed situation. So that's what we're focused on. That's our last fund, and this fund is focused on finding those deals. I mean, I want to buy everything in sight right now, because if it makes sense right now, boy, it's going to even make more sense later.
Yeah, absolutely. So like we have this challenge, high interest rates, others challenges, right? Expenses. So how are you able to find more deals and closing fund after fund?
But the deals are hard to come by. What we're doing is right now, as the time where we're recording this, debt is the problem for two reasons. Number one, well, three really. Number one, the interest rates are high. Number two, the lenders are requiring higher spreads. So that means they want to make more money because the risk is perceived to be higher.
Yeah.
And number three, their standards are tighter. So what that means is it's really hard to get a deal done. And I didn't even mention the volatility in the rates right now, right? You can go under contract, and 2 weeks after we closed our last deal, rates move 60 basis points. Well, that would have a massive impact on your deal. So what we've done is we're targeting far lower leverage. We're talking 40% or less. And we always had a value add component to our deals. So we know there's some upside when we go in, right? And it doesn't mean it's an old asset. It just means that there's some room there for rents to move. So in a couple of years, with the movement of rents that we are very certain that is there on day one, and as rates come down, I don't know when they'll come down, but I'm pretty sure they will. We'll be able to refinance and get our investors their capital back. And that's sort of the business plan. So, and this happened back in 2011, 2010. That is what disrupts the real estate market almost every time it gets disrupted. And so the way to buy during these times is take the debt issue off the table. And the only way to do that is use little or no debt. And then it's really not an issue in terms of getting closed. And when you're that, so when we add that to the fact that we pre-raise our money, right? We raise the money first. That's what a fund does.
Yeah.
And then go do the deals. I mean, we're in a really, really strong buying position, and sellers that need to sell right now need strong buyers that can actually close. So that's kind of our plan, and that's how we're approaching the current market.
Sure, absolutely. So you touched some very, very good points. So like if you compare debt versus equity, right? Debt is a bit cheaper, like you'll get for 5% to 7% range. But like if you're bringing more equity, that means you need to give better returns to investors, right? So how exactly that works, overall.
If we go in at 40% leverage on day one, and 2 years later we get you, because the value of the property is up, we get you most, if not all, of your equity back in 2 to 3 years, and you still own the asset. Well, that's how you get much, much better returns. Agreed?
Yeah, absolutely.
That's the
So
plan. That's the plan. And so it's not just a let's buy it with low leverage and hope rents go up, and rates go down. We do the same discipline that we've always done. And that is, on the way in, we make sure that we believe there's room for those rents to move. Now, rents in general are not moving up right now, but there are plenty of properties where maybe we just closed on a new deal out of construction, right? So when builders build, they're trying to lease very quickly. That means they're going to use concessions. That means they're not going to release at the top of the market. That is a perfect example. As long as you don't have a lot of new supply you're competing with, that's a perfect example of having upside built in. That's what we'll do. And that's why I just look back at everything that everybody did in 2011. If you bought in 2011, oh, I mean, you just made ridiculous amounts of money.
Yeah.
And so we're kind of in a similar scenario, just not as severe right now.
Sure, absolutely. So your exit plan is to like either refinance after 2 years or, or exit like after 2 years. That is the goal, right? So, okay.
Yeah, most likely it'll be a refinance and get you your money back. Because if you're an investor in that deal and you have 80-90% of your money back, you're not unhappy, especially if you're still getting distributions.
Yeah, totally agree on that one. So from fund point of view, what kind of asset classes, you're targeting right now?
Yeah, AB.
Yeah, and B.
Yeah, we've always stuck to good neighborhoods. That's not going to change. I just think that there's equally as good of opportunities in the AB space as there are in the C. I mean, everything's trading right now based on some cap rate that is directly tied to interest rates, right?
Yeah.
Well, there's very little difference between an A and a C. Well, if you can get an A quality asset at a cap rate that's equivalent to a C, like, well, I don't know why you wouldn't do that.
Yeah.
Yeah. So I see you smiling because that's exactly what's happening right now.
Yeah, that's what I do see, like, yeah. So which markets you are targeting, Ken?
We're deep in Florida. We've always been deep. Well, not always. For the last 15 years, we're deep in Florida, but we'll consider anywhere in the Southeast. We want that demand to exceed supply equation. That has to be in our favor. That's the bottom line. So we like growth.
Got it. So from last 2 years, apart from interest rates, what other challenges did you see in the market, and how exactly like you guys are navigated, like, from a net operating income point of view, like rents were stable like last year and this year, even we can expect next year, mid of next year, right? Because of a lot of supplies coming. So rents are almost negative to almost zero or something very positive, very less positive, right? So how exactly you guys are managing that?
Yeah. So, I mean, what's really hurt people now is if they had, let's say they bought 2 years ago, right? The quote unquote height of the market, right? Very low cap rate. If they weren't disciplined about developing their business plan and weren't absolutely certain that they could get that rent upside, or if they bought and they didn't successfully implement that business plan. So we look for $200 to $300 in upside. That's what we're looking for. And so if you think back over the last couple of years, if we are able to take a 100-unit property and add $200 of new cash flow to that property, that's like $240,000 a year, right? Did I do the math right? Yeah, $240,000 a year. That gives you a lot of new NOI to absorb what's happened, and this is the issue, inflation. Costs have gone up because of inflation. So you've got to manage that side. Executable, and did execute on that plan. If we didn't get the rents that we thought we were going to get, because what we try to do is get them on day one. That's what we try to do because we've done that much research. If you weren't able to execute, you didn't have any new cash flow to cover these new expenses. And that is a really big problem. So that's how we've navigated that, right? So our business plan is always trying to get in at even leverage and have 200 to 300 in upside. And if you do that and stay disciplined, no matter where you're at in the cycle, you're probably going to be okay, right? There's no guarantees in life at all, but it just stands to reason that if you've got all this new cash flow to cover whatever might happen to you, like hyperinflation, there's a pretty good chance you're going to be able to deal with that, right?
Yeah.
Because in the real estate market, especially multifamily, when things get rough in our business, your job is to just not screw up and lose the property, because you just need to wait it out. Yeah. People are still going to need a place to live. And as long as you're in a growth area, it's going to come back. And that's what people saw when they bought in 2011. That's why we're so excited about buying right now.
Yeah, absolutely. So along with like, there are another factor, like if any investor purchases with bridge loan, there is no other expense. You need to purchase rate cap or, variable interest rate. So, at the same time, these other factors, right? So, yeah.
Yeah, no, you're right. So if that business plan with the bridge loan usually means you're going to raise rents. If you're not able to raise rents and then rates went up on you, that's when you're toast. And that's what's happening. Yep.
Yeah. What is your your company's plans for next, 12 to 24 months? What kind of asset classes you're targeting, or
Same,
what kind of
AB.
strategies are trying to, yeah.
Yeah, AB class assets. Yeah, because I think if this is going to go on for probably the next 12 to 18 months. It could be shorter, it could be longer, I don't know, but there's going to be tremendous buying opportunities and we're going all in. I mean, I'm personally going all in because I think I didn't get to buy in 2011 for personal reasons, but there's zero chance I'm missing this opportunity. I can guarantee you that. So,
So, yeah, from pricing point of what do you see in the market? So compared to peak like 2021 or first quarter of 2022,
yeah, so you in terms of cap rates?
cap rates, prices,
Yeah, well, the prices are going to depend on the asset quality. So that's going to be all over the map. What's important is that if you can get a new asset close to a 6 cap in the state of Florida,
yeah,
in a good market, I mean, you tell me the last time that was possible,
yeah, yeah,
but they're happening.
correct. Yeah.
They're happening. So that, back in 21, cap rates are 4%. So are loans, right? And so you're fine, especially if you added more income. If your business plan, like I said, required you to have some upside here, you're going to be okay. And then you just need to wait out because cap rate, I don't know that they're going to go to 4, but they're not going to hang out up here forever. At least I don't think so.
Yeah, absolutely. Even like class properties also sold around 4.25 cap rate, like around 2021 time. Now, like class A properties for 6% cap rate, absolutely. There's no brainer to go after it, right? So,
Yeah, it's a
yeah,
no-brainer. Yes, sir. Yeah, I
awesome,
agree with
awesome.
you.
Are you also looking any kind of, new construction or any other asset classes?
Yeah, so we'll buy. I mean, we just closed on a property called the Levi in St. Pete, a beautiful property, close to a 6 cap. We won't build. We are not ground up developers, right? I'll much rather buy from the developer. They know how to do what they know how to do. I know how to do what I know how to do. I don't know how to do what they do. So I'll be happy to buy from them, let them make their money and, let me get it at a decent price and let me run it
Yeah.
for the next 5, 7, whatever years and let us make money on it.
Yeah, absolutely. So what is the difference between Class A versus Class B in terms of overall exit plan or business plan, managing? You're basically managing different, tenant base or anything, right? So share me
Yeah.
that, so
Yeah, so as you go up and down the asset quality ladder, so to speak, I don't know what else to call it, ABC.
yeah,
The further down you go, your hold period just tends to want to be shorter, right? Because the older the asset, the things inside the wall, things underground, they start to deteriorate. So, the maintenance expenses tend to be higher. So that's if I were to draw an analogy between what would I do with an A class asset versus a C, the number one thing I would change is hold period, right? I'm comfortable holding a new asset. Even if I had to hold it 10 years, I'd be cool with that. I mean, it's a brand new asset, right?
yeah.
But if it's a C property that, has been around since the 70s, oh, do I want to hold that 10 years? Probably not, right? It's going to be a slugfest to hold it for that long because that's just the nature of those properties. Nothing wrong with them. I'm just saying you need to be prepared for, the operations are going to be tough because of the maintenance costs associated with an older property.
Yeah. So from if you come to A class properties, there is not much, value add components, right? It's like more about,
Well, yeah, but be careful with that because newer properties, remember, it depends on how you define value add. So value add means somehow you're adding value to that property. And how do you add value to a multifamily property? By moving income, right? That's how we make money in this business. So I will tell you, one of the best deals we bought back in 2016. It's called Arbors at Garden Grove. And we were going to exit that in 3 to 5 years. But then we realized, well, first of all, our renovation budget was a whopping 50 grand, right? That is not a lot of money. All we did is the pavers around the pool and redo the pool. We have held that property now for 8 years and moved rent $650. We raised 2.2 to do the deal, 2.2 million. We returned that 2.2 million, another 1.8 million. We still distribute cash and they have 5 million in equity. See, so there's an example of a value add that required a whopping 50 grand in renovation, right? There's no renovations there. So I want you to be careful. People define that value add thing. They think it's we got to go in and gut everything and do kitchens and do baths and do that is a potential value add plan. It is not necessarily the plan you have to follow. And so, the deal we just bought, we're going to gut brand new kitchen. No, that's not going to happen. But we know there's upside in that property,
Yeah.
right? It's because we'll do some things. We're going to tweak some things to make it even nicer. But, I can see Levi turning into a very similar Arbors and Garden Grove thing, right?
Yeah, absolutely. Like, in terms of improving like operations or improving that economic occupancy or, other
Yep.
income or something like that, right? So, yeah,
Yep.
awesome. So, would you share any, best experience like last 2 years, anything like related with real estate, multifamily, or
It's the discipline side of this business. That's what, if I were to have any of your listeners take something away from this, and that is just stay disciplined. Don't worry if somebody else is willing to pay more, move on. There's always another deal, but stay disciplined. Don't do things that, oh, I think I can do this, right? You've got to do deals that, man, I feel really good. I know I can do this, right? Because you can't make guarantees in life no matter what, but you need to have a level of conviction about your business plan that is really high, and that comes with discipline. And so the biggest mistake a lot of people made over the last few years, it's called, you've heard of FOMO, fear of missing out. And they heard, oh my gosh, he's doing deals and they're doing deals, and I want to do a deal. And then they go do a deal, but they don't do a good deal. And now they're in trouble, right? FOMO will always come and bite you. It just will. So that's the number one lesson of the last several years. Stay disciplined. If you want to be successful in this business long term, just stay disciplined. And if you miss out on a deal because you stay disciplined, well, that's better than losing somebody's money. Agreed?
yeah, totally. So, would you also share any challenging experiences, last 2 years?
Challenge it. Well, COVID, I think it would be safe to say COVID. We manage our own stuff. And sometimes that's a blessing, sometimes that's a curse. But the reality of it is, we do it. We'll probably never stop doing it. And it's because, especially when you have things like COVID, we had to re-engineer the way we operated our business and the way we handled leases. And, we changed so much about how we operated. That was the challenge. I mean, that was no doubt a challenge. Now, other than the horrible side of COVID, what it did force us to do is become a lot more open. Like, we're on a Zoom call right now that would have never existed pre-COVID. There's zero chance you would have got me. I live on Zoom now. It is such an incredible way to communicate with residents, with team members, with whoever, with investors. I mean, it's just incredible. That is an example of, although it was very challenging, and again, it's really hard to ignore the horrific things that went on during COVID, there were some good things technologically that came out of that experience. And we've tried to really keep those and implement them into our business. But it was a challenge there's no question about it. It was challenging. But, when you take people's money, to date, we've raised $43 million. And when you've raised that amount of money, those people trust that you're going to figure it out. And I feel like we always do. So, but that was a challenge. I don't know that there was a bigger one for anybody other than that over the last few years.
Yeah, awesome. Thank you very much. So, what's your view on like capital raising in the last 2 years because of, market is different, right? Compared to
Yeah.
2021 before that. So, yeah.
Yeah. I think what's happened, some of those people that got FOMO, they went out and raised money and their deals are struggling. So what I'm seeing happen is that investors are becoming more careful about where they place their money, because now they realize, oh, you can lose money in this business. I need to be more careful. So that's what I think has been the biggest change with raising money. I mean, we've been doing this 26 years. We've done 19 deals, managed 16,000 units. I mean, we've been at this for a really long time. So I honestly think the challenges over the last couple of years have actually helped us, because people are seeing that experience does in fact matter, and it matters in ways that they didn't understand before. So that's capital raising now. Is, if you're new, I think it's harder. If you're experienced and have a really good track record and so on, I don't want to say it's easier, but people understand, right? The message that you have and the credentials that you've developed over a long period of time matter more now than people used to give them. Does that make sense?
Yeah, absolutely. Investors are now well educated and they're like,
Yeah, right. Absolutely, they are. Yep.
So what's your take on interest rates when exactly it will go down, you know? So any thoughts on that?
So, you're going to get to play this 2 years from now and see how wrong I was. But look, I'm not qualified to make interest rate projections. I do feel like they're probably going to go down. Sometimes when things seem obvious, they don't always happen, right? That's when you get surprised the most. So that's the only reason for my caution here. I do think rates have to come down. I think they have to come down for a lot of reasons. And that I do think they're not going back to where they were. That's not happening. We're not going to go back to a 5 basis point SOFR, right? I mean, I don't know where it is now. I haven't borrowed on variable rate for a while, but I would say treasuries are at 4.5 plus or minus right now. I'm going to guess they'll be in the mid threes if I were to guess in a couple of years. So it'll be interesting. I'm going to come back to this in 2 years and see how right or wrong I was. So we'll see. Just
Yeah,
don't take it to the bank. That's all I ask you to do. Don't take it to the bank. It's just one man's opinion.
absolutely. So what's KRI's plan, KRI Partners plan next, not 12 to 24 months?
It is to buy everything we can with discipline like we have. But I'm just telling you, if you can bring down some high quality assets close to a 6 cap, I'll take that all day long.
Absolutely.
I'll take that all day long. So we are in full capital raise mode. We expect our current fund to be 15 to 20 million. And that'll give us a great deal of capital to deploy. And we're just going to continue to do that because I think there's really good opportunities out there.
Sure, absolutely. So any new habits that are helping you to be successful?
New habits?
Yep.
Yeah, boy, that's a good question. You threw me a curveball there. I'm always trying to get better. The number one thing that I've been focused on lately is trying to avoid shiny objects. That's what I call them, right? I mean, as you come to work every day, you have a plan, right? This is what I'm going to do today. And all of a sudden, there's something over here, and there's something over there, and there's something over there. And you've got to learn to try to ignore the shiny objects as much as you can to keep yourself focused. That's been the lesson of the day for me, because we just have so many things going on.
Thank you. So any recent books that impacted you?
Well, I am constantly reading and listening and trying to learn as much as I can. I'm a CPA and lender by background, so I'm, not the sales marketing kind of guy. So I've been spending some time in the sales and marketing arena, looking at Cardone. Obviously, Grant Cardone knows a little bit about sales and marketing. I think that's fair to say. So I've been spending some time trying to figure out this whole sales and marketing thing because it's just new. I'm a numbers guy, and it's really funny trying to I don't know, left brain right brain thing, right? Trying to
Yeah.
figure all that out. But that's probably, he wrote 10x rule, I think, or something like, yeah, 10x rule. That book has been one that I've read, but he is obviously he's a very good sales and marketing guy, and guys like me could learn a lot from him. So that's been my focus, is trying to develop that side of my skill set.
Yeah, absolutely. So how can listeners can connect with you, Ken?
Oh, absolutely. So KRIPartners.com. That's our website, KRIPartners.com. We have two things that we do. We basically help people create wealth through real estate. Now, if you don't want to do your own deals, stay in our funds and things like that. If you do want to do your own deals, we have a whole entire investor education side of our business that is basically teaches you everything that we do and that we have done for 26 plus years and been really successful doing it. So KRIPartners.com. That's the best way to find us, and then reach out to me. There's, just write me a little note on the website. It's easy to do, and I will get right back to you.
Yeah, absolutely. And thank you very much, Ken. Thank you again for joining us.
My pleasure.